Income tax 2020, W-2 income. Come in, relax with income tax 2020. W-2 income. When thinking about W-2 income, we're at the top line of our income tax equation, remembering that we can think about the income tax equation in two separate parts. Basically, we can cut it in half. The first half being a type of income statement on a tax basis. The second half being the calculation of the income tax based on the taxable income, and then the payments as well as the credits to get down to the tax refund or amount due. We're thinking, of course, at the top half, when we're thinking about the income line item, we're thinking about the most popular or most used form of income, the one that comes to mind most, that being the W-2 form. Here's a look at the W-2 form. Remember that the W-2 form is given by the employer to the employee. So that means if you've seen a W-2, that indicates that the person that has the W-2 was an employee, not a contractor of the business. If they were a contractor, then they would be getting a 1099 form, if anything, as a contractor. Also note that the W-2, we have a W-2 with the client or ourselves if we're the employee doing our taxes. And then, of course, the employer sent a W-2 to the government as well. So remember, when you're thinking about these types of forms, why would the business do this type of form? Why would they go through the trouble of doing it? Because, of course, the government has leverage over the business who wants the deduction for employee wages, which is a huge deduction. And therefore, the IRS can ask then the business to provide W-2s not only to the employees, but to the government. It's important for us to note as we do the data input that the government has a copy of the W-2 form, because that makes our job a little bit easier as well, because it's quite likely that at some point you're gonna have a client that's gonna say, hey, look, I think this W-2 is wrong. There's wrong. I don't think it's correct, and we need to do something about it. Well, note that on our side, there's not a whole lot we can do except to ask the employer to make the adjustment and corrections to the W-2, because if we report anything different on the W-2 than is what has been given to the IRS, we will almost surely get a letter saying, hey, there's a discrepancy, and we will have to deal with it at that time. We might as well deal with it now and fix it now. If you think there's a problem, how can we fix it? Well, we'll have to go to the employer. So the only way to fix it really is to go to the employer and say, hey, could you correct the W-2? We think there's an error. Send it to the IRS so they have the correct copy of it so that we can then file the tax return, which will then line up with what the IRS has. So it's useful to understand that so that you could say, hey, look, if there's a problem, we gotta do that in that format. Okay, so let's just go over the W-2 basically line by line here. So we got the employee social security number. That, of course, is like what the IRS sees you as or the client here, because they see him as a number. So we're all numbers here. That's social security number. Then we have the employer identification number, which is basically kind of like the employer's social security number. It's like a business number. That's what they see the employer as. That's the number they see the employer as. And then we have the employer's name, address, and zip code. Now, note in the tax software, oftentimes more and more the IRS is actually asking for this information, the employer identification number and even the address and so forth. As it's becoming easier for us to input data into software, because software is getting better, the IRS is asking and requiring more information, such as the address and whatnot, as we go forward. So we're going to need this information oftentimes to input into the system, not just the numbers and not just the EIN possibly. So then we have the control number, we've got the employee's first name, last name, and then we have the employee's address as well. Then we've got the actual numbers that need to be reported. Box 1, of course, being wages, tips, and other compensation. So this is going to be the compensation basically for federal income tax. Now, it's important to note here that this is going to be, what we're going to be recording the tax on, but some things it doesn't represent, in other words, total wages necessarily, because some things might have been received, which would basically be wages to the employee, but they are not taxable. They've been taken out of taxable items for federal income tax purposes, such as a retirement plan like a 401k, which we'll talk about shortly. So although box 1 is the taxable wages, if you're trying to think about how much do I actually earn, box 1 may not be the first place you would want to go, because it might not be including things that you're earning that are not taxable. And then the federal income tax in box 2, the federal income tax withholds, that represents all the money that was taken out of your wages and then given to the government. And they did that based on basically the W-4 that was filed with the business, and then based on the rules related to that W-4. So obviously, the employer, in theory, has your money that would go to gross income. They took some of that income out for federal income tax purposes in accordance with the W-4s and the law related to it, gave that to the IRS. In theory, that then is the money that you actually paid the IRS. Obviously, of course, you didn't directly pay it. The employee never got it, never saw it, right? It got taken out directly by the employer and paid to the IRS. Then we have box 3, and this is where it gets a little bit confusing. We got the Social Security wages. Now, when we think about the Form 1040, we're concentrated on federal income tax. Social Security tax is another tax. It's also a federal tax, but it's not federal income tax. It's Social Security, which we often think of as basically an employee type tax. But it's similar to a federal income tax in that it's going to the federal government, the main difference being that the federal income tax goes into kind of like the general fund for the federal government. They can do whatever they want with it. But the Social Security, in theory, they're limited to be giving out the Social Security money that they get into a different fund that should be going to Social Security benefits. So they kind of separate that out. And notice the Social Security, although we put it in for like a normal type of return, if you just have W-2 income for Social Security, in other words, especially if you only have like one employer, then it should be calculated correctly for it, meaning we should just be putting this in for informational purposes. We shouldn't be owing tax or getting a refund based on Social Security. Why? Because Social Security is basically a flat tax, meaning the amount that was withheld can be known and should have been done correctly when it was taken out of the wages. So it got taken out of the wages as well, and it should have been done correctly because it's not a complex tax. We cannot do that with the federal income tax because the tax code's too complicated. That's why we kind of shoot for a refund. It's too complicated for us to get it exact because we have a progressive tax system and you got all these other things that could impact the taxes. Social Security, hopefully, most of the time it is just an informational thing. You're putting it on there to show the Social Security wages that have been withheld, but it may not be a factor. Now, there's some exceptions to that. We'll talk about some exceptions to that. If you're like a Schedule C type of business, then you'll have to report self-employment tax, which is kind of like Social Security because it has the taxes related to Medicare and Social Security. So we'll talk about that in the future. And then we got the Social Security tax withheld. This is the money that was taken out of your paycheck, but not going to federal income tax, but to Social Security taxes. Now, note that this is also can be different. Box 1 and box 3, although they're both income, could be different because there could be things that were deductible, say, for W-2 wages, like a 401k plan, that were not deductible for Social Security. Or there might have been a cap on Social Security. It caps out at some point, and therefore, if you make over a certain amount, box 1 might be higher than box 2. And then box 3 is another income type box. That's the Medicare wages and tips. Medicare wages and tips. That's, again, another federal program, a federal tax. We call it basically a payroll tax generally. And it's something that, once again, should be similar to Social Security in that it's kind of more of a flat tax. It's not as complex as a federal income tax. So you should be reporting it mainly for kind of informational purposes. You're going to report the amount of the tax and the amount of the withholdings related to it. These two withholdings, Social Security and Medicare, are not within the calculation when you're thinking about the federal income tax withholdings that are kind of like generally the bottom line of the tax calculation. So when you think about the withholdings, the money that was paid out on the Form 1040, you're generally concentrating on the federal income tax when you're looking at the payment side of things. Then we got the Social Security tips, if applicable, allocated tips, if applicable, dependent care benefits. So dependent care benefits are provided by employer to an employee for use in caring for dependents, such as young children or disabled family members. And then we have box 11, non-qualified plans. So non-qualified plans aren't as common for most taxpayers or most W-2s. Non-qualified plans are retirement saving plans. They are called non-qualified because they do not adhere to the Employee Retirement Income Security Act, or ARISA guidelines. Non-qualified plans are generally used to supply high-paid executives with an additional retirement saving option. Then we have Box 12A, Box 12B, Box 12C. There's going to be instructions on these boxes. These could adhere to different things. There could be like a letter next to these boxes to tell what exactly it is. It might be like a cafeteria plan, or it might be a retirement plan such as a 401k or 403b. These, if it was like, say, a 401k or 403b, will typically have a tax benefit. So when you think about the difference up here, for example, box 1, which would be the federal income tax or the federal compensation for federal income tax compensation, might not be including something like a 401k plan, the amount that went into a 401k plan, because it wouldn't be taxable for federal income taxes, although it might still be included in box 5. And the difference then you might see down here, basically in a retirement plan. The difference might be the money here that was put into a retirement plan. We'll see an example of that in a second here. Then we have the state information, if applicable. Now we're focusing here on the federal income tax mainly for this course, but of course the W-2, depending on the state that it's in, will also provide the state information, employer state ID number, state wages, tips, and so on, state income tax, local wages, tips, and etc., local income tax, and so on. So a similar kind of process for the state tax. We don't have, of course, Social Security and Medicare basically down here in the state. We're talking about state income tax for those states where the state income tax will be applicable. Now, this is basically just a worksheet that's similar to a W-2 that we're going to be using kind of in Excel so we can think about these things. Now, I'm just going to be focusing in on these boxes up top for the 3 wage boxes. So remember, we had 3 boxes that were basically for wages. It's quite common that these 3 boxes might be the same, especially if we're talking about low to mid-size income levels. So, for example, now we have the federal tax, box 1, wages and compensation, $40,000. This is the amount that was withheld. We're just basically making up the numbers here, but $4,000. And then the Social Security, which is going to be the $40,000, the amount that was withheld from the Social Security, the $2,480, and then the Medicare was $40,000, amount withheld $580. So these 3 boxes then are the same. The compensation is the same. Retirement plan, we're going to assume here that there's no retirement plan, like this was unchecked. So there's no retirement plan down here, or at least they didn't opt in to any retirement plan. If they had a retirement plan, we're assuming they didn't put any money into the retirement plan. Now, we could have a situation that would look something like this. So now we have a higher income level, higher income threshold. Box 1, federal income tax, is $150,000. We didn't put anything into the withholdings. We're just looking at box 1, 3, and 5. The Social Security then caps out at $137,700. So Social Security caps out, and that's kind of weird to some people. Why would the Social Security cap out? Notice that after this point in time, the $137,700, you're basically not paying any more Social Security on the wages. Even though you earned $150,000, you're only paying Social Security tax up to $137,700. Why would that be? Well, one of the reasons for that is because the money that goes into Social Security, you can think of it kind of like a retirement plan. It's going to be like a safety net program, but it's also kind of like a retirement program, the way, a benefit program from the government basically is. It kind of depends how you want to think of it, or how we want to think of it as a country. Is it like a security program, or is it kind of like a federal retirement program or something like that? But in any case, the money that you would get back of the Social Security benefits, when you start receiving the benefits, will not have an impact above a certain threshold, meaning they're going to be basing your benefits on your earning years. So they're going to take like your highest earning years, and they're going to be basing the benefit calculations on what you have paid into it. You've paid into it. Now they're going to be paying back out at basically retirement time, and you're only going to get a benefit for the amount that you have paid in up to a certain point. So that's part of the logic, or part of the reasoning, that there's going to be a cap. But in any case, just with filling out the cap, that means you could have a difference between box 1 and box 3. Now, between box 1 and box 3 then, box 1 is closer to what was actually earned, because obviously box 3 capped out at that amount, right? At the cap for Social Security. And then box 5 doesn't typically have a cap. So box 5 for the Medicare will still be at, in this case, the same 150,000. Now these three boxes could be different too. They could all be different. For example, you might have a situation box 1, 140,000, box 3 still at the 137.7, and box 5 at 150. Why would this be the case? Box 3 still capped out. It hit the cap, so it's not going to be going over the capped level. And then box 1 and box 5 are different by 10,000, and that might be something that was deductible, say for federal income tax purposes, meaning it's not included in box 1. However, it's not something that's deductible, say for Medicare taxes, and the most common thing there would be, say, a retirement plan, which might be reported down here on box 12. So on box 12, you might see a retirement plan, and it might have like a D next to it, which would indicate what it's for, and then you can look in the instructions and you say, oh, that's for a 401k plan or some type of retirement plan. And that's why there's a difference between box 5 and box 1. Now, when you just do the data input into a tax return, it's pretty straightforward. You're just going to enter box 1 where it says box 1, box 3 where it says box 3, and box 5 where it says box 5. But if you talk to a client about these things and you're doing planning into the future, they may well ask you what are the difference between these three boxes, and it's useful to be able to understand, why these three boxes would be different. They also might have concerns about their compensation and see whether or not, what they're receiving is fair. And oftentimes people actually, they feel bad because box 1, they think that's their income and they think it's lower than it should be possibly, but really that's not reflecting their total income because they may have put a lot of money into a 401k plan, which is really income. It's income. It's just not being reported in box 1 because it's not taxable income. So if you look at the W-2, then box 5 is actually closest, which is the Medicare wages, to what they actually earned. So you want to say, okay, box 5 is the closest, and even that might not reflect their total earnings because they might have like a cafeteria plan that was deductible for Medicare wages even. But if you want to know how much someone actually earned, then you're probably looking box 5. If you want to know what they're taxed on for federal income taxes, you look at box 1. If you want to know, the difference between box 1 and box 5 will typically represent something that was not taxable for federal income tax purposes, but is taxable for Medicare tax purposes. And often that's going to be, say, a retirement plan. You could have situations where cafeteria plans or something like that could have an impact on the wages as well.